$300 million, and every single dollar of it was borrowed against the same collateral. At the same time, from 17 different lenders, who each believed they were the only one. ESM Government Securities wasn't a household name. It operated out of Fort Lauderdale, Florida, in the kind of nondescript office that could belong to an insurance adjuster or a regional accountant. The firm traded government securities, treasury bonds, the safest instruments in the American financial system. The irony of that would become apparent soon enough. The partners who ran ESM were not criminal masterminds in the cinematic sense. They were men who made a mistake, covered it with a lie, and then spent years covering the lie with more lies, each one larger than the last. It is the oldest financial story in the world, but the scale of what ESM eventually touched, 71 banks, an entire state, and the ghost of the Great Depression, made it something else entirely. To understand how ESM worked, you need to understand what a repurchase agreement is. A repo, in the language of finance, is essentially a short-term loan. A firm like ESM sells a government security to a lender and agrees to buy it back the next day or the next week at a slightly higher price. The difference is the interest. The lender holds the security as collateral. It is a routine, seemingly low-risk transaction that forms the plumbing of the bond market. The problem at ESM was that the firm had taken losses it couldn't admit. Rather than disclose those losses to clients or regulators, management chose to hide them, and to keep the operation running while hiding them, they began doing something that would eventually be described in court filings as pledging the same collateral to multiple lenders simultaneously. In plain terms, they sold the same bond to more than one buyer as security for more than one loan. Each lender believed they held something unique. None of them knew the others existed. This isn't a sophisticated fraud. It is the financial equivalent of selling the same car to 5 different people and hoping none of them shows up on the same day to drive it away. For years, no one showed up on the same day. ESM kept the machine running by rolling its obligations forward, borrowing from new parties to pay old ones, which is a pattern that should sound familiar because it's the same engine that drives every Ponzi scheme ever constructed. The numbers kept growing. By early 1985, the hole in ESM's books had reached approximately $300 million. Here is where the story acquires a specific human face. A man named Jose Gomez was the outside auditor responsible for reviewing ESM's books. His firm issued clean opinions on ESM's financial statements year after year. In 1985, it was alleged in subsequent legal proceedings that Gomez had received approximately $10 million in payments from ESM's management over the course of the relationship. In 1986, Gomez pleaded no contest to charges related to his conduct. He was sentenced to 12 years in prison. A $10 million payment to the one person whose job it was to find the fraud. That isn't an accounting failure. That is the architecture of concealment. The unraveling began in early March 1985, and it moved with the speed that financial collapses always move once the first thread pulls loose. A firm called American Savings, a major creditor of ESM, grew concerned about its exposure and demanded its collateral back. ESM couldn't produce it. On March 4, 1985, ESM Government Securities was shut down by regulators. The firm's books were opened. What auditors found inside those books set off a chain of consequences that would reach across the state of Ohio in a matter of days. One of ESM's largest counterparties was Home State Savings Bank of Cincinnati. Home State wasn't a federally insured institution. It was insured by a private fund called the Ohio Deposit Guarantee Fund. a state-chartered alternative to FDIC insurance that covered approximately 71 savings and loan institutions across Ohio. Home State had approximately 145,000 depositors. When news of ESM's collapse became public, those depositors did what depositors have done since the invention of banking when they are frightened. They went to their branches and they asked for their money. The run on Home State began the day after ESM closed. Lines formed outside branches in Cincinnati. Reports estimate that depositors withdrew approximately $150 million from Home State in a single week. The Ohio Deposit Guarantee Fund didn't have the reserves to cover those withdrawals. It had approximately $130 million in assets to cover a system with billions in deposits. The math wasn't survivable. On March 8, 1985, Ohio Governor Richard Celeste made a decision that had not been made by any American governor since the Great Depression. He ordered the closure of all 71 savings institutions insured by the Ohio Deposit Guarantee Fund. A bank holiday. Not one bank. Not 10. 71. Hundreds of thousands of Ohio depositors woke up that Saturday morning to find their savings institutions padlocked. The governor's order allowed depositors to withdraw up to $1,000, a figure that would have felt almost insulting to anyone who had more than that inside. The legal proceedings that followed took years. ESM's principals faced federal charges. The man who had run Home State, Marvin Warner, was eventually convicted on multiple counts related to the failure of Home State and faced additional civil liability. The losses to depositors, counterparties, and the state of Ohio ran into the hundreds of millions of dollars. Recoveries were partial at best. The Ohio Deposit Guarantee Fund itself was dissolved. The 71 institutions it insured spent months under restrictions before being allowed to reopen, with most eventually converting to federal FDIC insurance or being absorbed by other institutions. Some depositors waited more than a year to access the full value of their accounts. Others lost portions they never recovered. The deeper consequence of ESM was legislative. The collapse accelerated regulatory scrutiny of private deposit insurance schemes across the United States and contributed to a broader national conversation about the gaps between state and federal oversight of financial institutions. It was a preview, in miniature, of the much larger savings and loan crisis that would engulf the United States by the end of the decade. But step back from the legislation and the court records and the congressional hearings, and the thing that remains is remarkably simple. A firm lost money it couldn't admit losing. It hid the loss. It paid the one person who might have found the loss to look the other way. It kept operating until it couldn't. And when it finally stopped, 71 banks closed their doors in a single morning, and hundreds of thousands of people who had done nothing wrong found themselves standing outside locked buildings wondering if they would ever see their savings again. Money dies in layers. The first layer is the original loss, which is almost always survivable if admitted early. The second layer is the concealment, which transforms a wound into a disease. The third layer is the contagion, the moment the disease spreads beyond the original patient to everyone who trusted the system around it. ESM never grew large enough to threaten the national economy, but it was large enough to remind an entire state that the difference between a bank and an empty building is nothing more than confidence. And confidence, once broken at scale, doesn't repair itself in a weekend.